So you're taking the leap and starting your own law practice in New South Wales? That's fantastic. But before you get too far, we need to talk about the absolute bedrock of your entire operation, your trust account. Let's get right into it.
Look, it's a huge deal, right? So much excitement, so much ambition, and let's be real, probably a few sleepless nights. You're out there hustling, building your brand, getting clients, but amidst all that chaos, there's one thing in your back office that can literally sink your new firm before you've even properly set sail.
And that one thing is how you handle your client's money. I'm not kidding, this is your most important lesson. This isn't just about good accounting. It's about your ethical duties, it's about compliance, and it's about the very trust your practice needs to survive. Get it wrong, and the consequences are, well, they're serious. But here's the good news. The rules are actually really clear, and we're going to walk through them step by step right now.
All right, so where do we even begin? First things first. Before you can properly manage trust money, you've got to know exactly what it is. You have to be able to spot it, no question. Because any confusion right at this stage, that's where the problems start.
Okay, so the Legal Profession Uniform Law, we'll just call it the LPUL, it gives us a pretty clear definition. Basically, it's any money that's entrusted to you in connection with legal services. The key thing to remember is it's usually for services you're going to provide. Think of it this way. The most common example is when a client pays you for legal costs before you've done the work and sent them a bill.
So, to make this super simple, here's a little test you can run every single time money comes in. Just ask yourself these 3 questions. Step 1. Is this money connected to legal services? If yes, move on. Step 2. Have I already done the work for this specific money? And step 3. Have I already sent a bill for that work? If you answered yes to number 1, but no to 2 and 3, congratulations, that's trust money. And here's the crucial takeaway. If you've already done the work, you've sent the bill, and the client is paying that specific bill, that is not trust money. That's your money. It goes straight into your office account.
Okay, so you've identified trust money. Now where does it go? This is where your primary tool comes into play, the general trust account. You really need to think of this as a completely separate, secure vault. It's where you hold your client's funds totally isolated from your practice's own money. And every single cent, every dollar that goes into that trust account has to be documented. The absolute first and most critical document is the trust receipt. The rule here couldn't be simpler. As soon as you get that trust money, or as soon as it's practicable, you must create a receipt. This isn't just a piece of paper, it's the beginning of your audit trail.
Now, Rule 36 is very specific about what needs to be on that receipt. And trust me, none of this is optional. You've got to have the date, the exact amount, and how you received it. Cash, check, transfer, who you got it from, the client's name and their matter reference, why you received the money, and finally, who in your firm actually made out the receipt. Each one of these details is like a building block. Get them right every single time, and you're creating this perfect, crystal clear record that protects you, it protects your client, and it protects the integrity of the whole system.
All right, your next critical habit, something you absolutely have to bake into your monthly routine, is the reconciliation. This is the non-negotiable health check for your trust account. Every single month, without fail, you have to prove that your internal records and the bank's records are perfectly in sync.
And what does that look like? Well, at a high level, it's this. The balance in your records, your trust cash book, has to perfectly match the reconciled balance from the bank statement. You've got 15 working days after the end of the month to do this. You have to reconcile your cash book against the bank statement, transaction by transaction. And then you have to make sure that the total of all your individual client ledgers adds up perfectly to that reconciled cash book balance. Everything has to balance down to the very last cent. And if it doesn't, you don't just move on. You have to find that error and fix it, period.
Okay, let's pause here because this next part is super important. This is the area where practitioners, especially when they're new to running their own firm, can get into some serious hot water. We're talking about the rules for withdrawing money from the trust account. One misstep here, and it could be a really big deal.
The number 1 absolute golden rule, this is Section 146 of the LPUL, is that you cannot, under any circumstances, mix trust money with any other money. Full stop. Your trust account is for client money only. Your office account is for your practice's money only. They are 2 completely separate universes, and they must never, ever, ever overlap. So, you've done the work, you've earned your fees. How do you actually get paid? Rule 42 tells you exactly how to do it. First, you issue a proper bill of costs to your client. Now, this is crucial.
That bill has to mention that you intend to withdraw the funds from trust. Step 2. You wait. You have to give the client 7 business days to get that bill and raise any issues. If that time passes and you haven't heard anything, then and only then are you clear to transfer your fees from the trust account over to your office account.
And to make this dead simple for you, the Law Society actually gives you the exact words to use. Just put this sentence on your invoices. It is intended to withdraw the above amount from money held in your trust ledger at the expiration of 7 business days from the date of this bill unless an objection is received. Seriously, just copy and paste this into the footer of your invoice template right now. It's such a simple, practical step that makes sure you're compliant every single time.
Okay, so the system isn't just a bunch of rules you have to follow. It's also got safeguards built right in. These are external checks and long-term duties designed to protect everyone, the public, your clients, and you.
So, once a year, your trust records have to be looked at by an external examiner. This is a mandatory independent audit. I know the word audit can sound scary, but really, think of it more like a professional checkup. It's there to make sure everything's in order and helps you maintain the high standards the profession demands. It's a good thing.
And this is a big one. Your responsibility for these records doesn't just end when the case is over. Not even close. Section 147 is crystal clear. You have to keep all of your trust records for a full 7 years after the matter is finalized and the file is closed. That's a long time. But it's about maintaining a complete and accurate history, which can protect both your clients and your practice for years to come.
So let's bring it all home. As you're out there building your amazing new practice, please don't look at trust accounting as just another boring compliance task you have to check off a list. It's so much more than that. It's the very bedrock of your firm. Getting this right from day one shows your clients you're a true professional. It guarantees their money is safe, and it builds the single most valuable asset any law firm can possibly have, a reputation for absolute, unshakable integrity. And really, isn't that what it's all about?